All right, we might get underway right now. We have a very large number of people that have joined the webinar and a very large number that have registered. Just for those need to know, we will be recording this webinar and it will be available and posted on our website in the next 24 hours. Just by way of introduction, my name is Richard Basil-Jones. I'm the CEO for the Australia United Kingdom Chamber of Commerce. We're delightfully located here in Australia House on the Strand and on a very sunny London day. It's always sunny in London, you know that. We've got a fantastic day ahead of us, morning ahead of us with this webinar. The Going Home is an annual event in terms of our hosting. It's a very popular item for a lot of people who are living in the UK thinking of heading home, and home is typically Australia, but not always Australia. Just by way also of introduction to the Chamber, just so there's a number of people who are friends of the Chamber, not necessarily members, just who we are and what we do. So we're a members organisation, we're a not-for-profit, we're independent. Whilst we sit in the government house here, we are independent. Our role is really supporting, informing, connecting those people that have business interests in Australia and the UK. And we typically do that via our events. And so our events, if you like, bring people together, and that way we can connect people, create networks, but also create an information sharing platform. So that's the role we play, and we host somewhere around the 35 events a year. And for those that are non-members out there, we're happy to have you join up or your companies join up. All right, some quick housekeeping before we get underway. We've got about an hour and 15, hour and 10 minutes left in this session. 3/4 of an hour of that time will be allocated and dedicated to the formal presentations, and we're allowing around 25 minutes for a Q&A. A number of people have submitted questions already. We'll try and address some of those at the start of the Q&A. And for those that have questions along the way, there's a Q&A button on your screen at the top. If you can use that particular button to submit your questions, we'll try and look at that on the way through and try and capture those and feed those into the question and answer forum as well. As I said, this session will be recorded, so you can go back to it at another time in the future. And just as terms of, again, housekeeping, cameras and microphones off for our guests throughout. Just, I guess, comment about this particular webinar. We have seen an enormous number of registrations, and I think there's probably a number of reasons. One, we timed this event just before winter hits in London for another 6 months. I think that may have rise to a lot of people thinking about going home. The joy of the oncoming UK winter is never a great one, but that, and always the timing is a little bit just before an autumn budget that the UK government hands down. I think those two items in combination may be having a particular impetus this year. I think, as we'll hear throughout this session, there have been a number of changes in the UK that affect, in particular, non-DOMs, expats here living in the UK. And I guess from where I sit, I'm not sure it's going to get any easier for the non-DOM population in the United Kingdom. And then again, Joanne is our expert in that particular area. So on that particular note, let's get underway. Let me introduce you to our three speakers. We have Joanne Lamberth and Geoff Taylor, who will be managing the financial side of this presentation. Their bios are on the registration area if you need to go and have a look at their credentials. We've worked with them for the last few years that I've been in place as a CEO, and highly professional and highly informative, and that's why we keep getting them back every year. This year we have a new member who's taking over for a particular session, and that is Paul Davies, who's General Manager for Careline Moving Storage UK. When they joined up as members, the opportunity to obviously have a removalist and moving company associated with a Going Home event seemed like a logical fit. So Paul, great to have you on board. All right, on that very note, I will be quiet. I will hand over to Joanne, and Joanne, the webinar is now yours.
Thank you, Richard. Bear with me while I just get the slides set up, ready to go. All right, so hopefully you should now be able to see my screen. Okay. So good morning, everybody. I'd like to start by putting today's webinar into a bit of context. So according to the Australian Bureau of Statistics, 147,000 long-term Australian residents arrived back home in 2024, while the UK Office of National Statistics states that 87,000 non-EU individuals arrived in the UK in 2024, and these statistics have been fairly similar in previous years too. So we might assume that a significant proportion of those Australians returning home each year are coming back from the UK, which might explain why so many of you have joined the webinar this morning. I moved to Australia with my family back in 2009, so I'm very much aware of the melee of questions and issues facing you as you plan your return home. What I will aim to do today is to talk through the most common issues faced by people in your situation. To start with, I'll look at how tax affects the decision to either sell or lease your UK home. Then I'll provide an overview of the issues of working through a UK limited company or continuing your UK employment in Australia. Next, I'll briefly go through the recent changes to UK inheritance tax or IHT and explain why you need to be aware of your IHT status once you're back home in Australia. And finally, I'll touch on a few of the other common tax issues for Australians returning home from the UK. Now, this is generic, not specific advice. It's really important to understand that there isn't a one-size-fits-all solution. It's vital to obtain personalised advice that considers the factors of your specific situation. So my intention is to flag the key issues so that hopefully you can identify where you might need some specialist advice. Effective, focused and tailored tax advice before your move can ensure that you don't fall into any tax traps and can save you a lot of money. Many Australians in the UK will own their own UK home, and often this will be one of their most valuable assets. So determining what to do with it when they go home is often a key decision. There are tax impacts of both selling the home and retaining it. So today I'm going to take you through the income tax, capital gains tax, and inheritance tax considerations that should inform that decision. Firstly, income tax. If you rent your UK property, but you're an Australian resident, the rental profit will be taxed in both UK and Australia, but the calculation of that rental profit won't be the same. You've got different tax years, different currencies, and very importantly, different allowable deductions. As a non-resident in the UK, your UK source income is likely to be lower once you've left, so the rental profit may be within the personal allowance and not taxed at all. Worst case is likely to be a 20% tax rate in the basic rate band. Whereas in Australia, you're likely to have other sources of income, and that's going to cause your rental profit to be taxed in the higher bands, could be up to 47%. Though on the plus side, any rental losses can be offset against your other taxable income. In the UK, you'll need to register with HMRC as a non-resident landlord to avoid having 20% of your gross rental income before any expenses are deducted at source. Double tax relief is given through claiming a foreign income tax offset or FITO in your Australian return, but this credit cannot create a refund. So the effect of the overall relief is that your tax liability will be the higher of the UK or Australian liability. And in most cases, that will be the Australian liability. Perhaps the bigger issue, because the money involved is usually much bigger, is how the sale of the property will be taxed. And it's really important to understand that at any point in time and throughout the world, you can only have one main residence for the purposes of the capital gains tax residence exemptions. And the rules that allow you to apply those exemptions are different in the UK and Australia. So a future sale of the property while Australian resident would mean that the disposal is subject to both UK CGT and Australian CGT, with Australia providing double tax relief through a FITO. But the phrase double tax relief makes it sound simpler than the reality, since the gains calculations in UK and Australia are really quite different. For the UK, While principal private residence or PPR relief allows for certain periods of absence from the property, beware, when you're resident outside the UK, the property only qualifies if you spend at least 30 days living in it each year, and that might create other tax problems, so isn't necessarily something you're going to want to do. So in most cases, the longer you hold the property before the sale, the bigger the UK taxable gain will be. If full PPR relief is not available, you might pay less tax if you wait and sell the property after leaving the UK. This is because the gain for non-residents is only taxed on the uplift in value from April 2015, which is the date that the UK introduced non-resident CGT. Whether that's the case for you depends on when you bought the property and how its value has grown. It's also likely that you'll have to make a 60-day report, which is a report of the sale and tax due within 60 days of completion to HMRC, and that's in addition to including the sale in your UK tax return, with penalties being applied for late submissions. The UK has its own capital gains tax, separate from income, and gains are taxed at 18 or 24% depending on the level of income in the year of sale. For Australia, Australia's only interested in taxing the gain while you were Australian resident. So in many cases, if you acquired the property while in the UK, you get a tax-free uplift on returning to Australia, which usually makes for a smaller taxable gain, though you do need a valuation to support this. If you've moved back and forth several times, though, the situation may be more complicated. The movement in the exchange rate over the period that Australia is taxing is also included in the calculation, and this can result in some strange situations. You could have UK gains becoming Australian losses, or vice versa. Australia also allows a wider range of deductions from the gain than the UK, and in some circumstances, ownership expenses like council rates and mortgage interest can be deducted from the gain. It really depends on how the property's been used. Unlike the UK, Australia doesn't have a separate capital gains tax. Instead, gains are taxed as the top slice of income, subject to income tax and the Medicare levy. And that means that the rate of tax applied could be as much as 47%. So it's better to sell in lower income years. The main residence exemption, MRE, and the CGT discount are important factors in reducing the effective tax rate. If you're returning to Australia for the first time after acquiring the property, you'll need to wait 12 months from the date of your return before selling it to get the full CGT discount, and that can reduce the maximum rate of tax from 47% to 23.5%. While Australia may allow you to continue to treat the property as your main residence for up to 6 years if you're leasing or longer if it's empty, what about the impact on the Australian properties you own? Is that the best choice? In many cases, you'll want to protect your new Australian home with the exemption. So, as for the UK taxable gain, usually the longer you hold the UK property before sale, the bigger the taxable gain will be. Finally, while Australia allows a credit or FITO for the UK tax, given the very different gain calculations, it isn't always perfect double tax relief. The last consideration is UK inheritance tax, or IHT, and I'll explain what this is and how it works in a moment. At this stage, you just need to know that if you have a UK property, you will always have an obligation to UK IHT. And having a UK property means that you'll need to have a UK will, in addition to your Australian will, and your executors will need to be made aware of their UK IHT obligations in managing your estate. In summary, there are a wide range of tax considerations that feed into whether to sell or lease your UK property when you leave the UK. There is no right or wrong answer. The key is to fully understanding the implications so that you can make an informed decision. For individuals returning from UK to Australia, there are two questions relating to working in Australia that often come up. First, I'm working through a UK limited company. Can I keep doing that from Australia? And second, I'm going to continue to work for my UK employer from Australia. What are the implications? There are a wide range of facets to answering each of those questions, but what I'm going to aim to do is summarise the key points. Looking at UK companies first, a lot depends on the structure and ownership. However, the most common scenario is a UK consulting company, where the taxpayer and maybe their spouse are shareholders and directors, and the company earns income from consulting. And perhaps it's built up significant retained profits during the time in the UK. The first problem is that the company's tax residence is impacted by the residence of the directors due to the fact that there are two company residence tests, one incorporation and two central management and control. So if we have a UK limited company whose director or directors are Australian resident, we potentially have a dual residence problem. Is that a problem though? Can't we just apply a double tax treaty? Well, unfortunately not. Since the 1st of July 2018, we've had the Multilateral Instrument, or MLI, which is an initiative of the OECD and has overlaid many double tax treaties, including the Australia-UK treaty. Under the MLI, a company dual residence position can only be resolved by applying to either HMRC or ATO for what's called a competent authority determination. This is not a quick process, but without it, the company's worldwide profits will be taxed in both countries with no double tax relief. Even if you manage to keep the company UK resident, you may either create a permanent establishment for the company in Australia, causing compliance and tax obligations in both countries, or the company may be subject to the controlled foreign company rules in Australia. All of these issues significantly increase the cost and complexity of operating through a UK limited company in Australia, making it quite an unattractive option. Then there's the issue of how the income you draw out of the company is taxed. Drawing dividends from UK companies as an Australian resident is really not very tax efficient. An effective rate of tax on profits of up to 57% is not unusual. Also, whereas liquidating the company while UK resident is subject to business asset disposal relief, in most cases meaning a top rate of tax on retained profits of 14%, if you're Australian resident when you liquidate, the profits could be taxed at up to 47%. And that represents an additional £33,000 of tax on every 100,000 of retained profits, which is really not ideal when you've worked very hard to build up those profits. So what's the solution? Plan well before you move. The other common arrangement is for individuals to continue their UK employment from Australia, and this creates tax issues for both you and your employer. Looking at your situation first, employment income is generally taxable where the duties take place. So if the duties are in Australia, it's Australia who can tax that income. But your UK employer must continue to deduct UK tax through PAYE unless you lodge a form P85 and get issued with an NT or non-taxable code. They also must continue to deduct UK national insurance for the first 52 weeks after your move. Employment benefits can also be problematic, as whereas the UK taxes these benefits on the employee, Australia taxes the employer through fringe benefits tax, and this mismatch can be really challenging to navigate. Without careful planning, a significant cash flow problem can arise, where you pay both UK and Australian income tax and national insurance on your income, and you can't claim the UK tax back until the end of the year. Looking at your employer, depending on your role for the company, you could impact the company's residence or create a permanent establishment and tax point for the company profits in Australia. The company might have an obligation to register for PAYG in Australia and withhold tax from your wages, and it certainly will have an obligation to pay superannuation guarantee, which is currently 12% of ordinary time earnings. If it provides employment benefits, it may need to register for and pay for fringe benefits tax as well. And finally, it will have legal obligations under Australian employment law. For example, the requirement to have workers' compensation insurance in place, amongst other things. So in short, early planning for this arrangement is vital for both you and your employer. Moving on to UK inheritance tax, or IHT. This is a complex tax, and with the limited time available today, what I will try and do is give you a little bit of a flavour of what it is, the new rules from 6th of April 2025 and who those impact, and how it affects you once you've returned to Australia. So what is inheritance tax? As the name implies, it's a tax on your assets when you die, but that's not all it is. In reality, it's a tax on transfers of value, both in your life and on your death. And a transfer of value is anything that reduces the value of your IHT estate. So imagine a gift to your son or daughter to help them buy their first home. That would be a transfer of value and is potentially subject to inheritance tax. There are two types of lifetime transfer: chargeable lifetime transfers, which create an immediate charge to inheritance tax, and potentially exempt transfers, or PETs, which are only chargeable if you die within 7 years of making the transfer. Each individual is entitled to a nil rate band, currently £325,000, and sometimes an additional residence nil rate band of £175,000, but that's subject to conditions. And there are some other specific reliefs and exemptions that can apply to certain assets. The rate of inheritance tax is 20% on lifetime transfers and 40% on death, so it's not an insignificant tax. And importantly, the reason you should consider IHT when going home is that normal Australian tax and estate planning decisions, like setting up a family trust, can trigger an immediate lifetime inheritance tax charge, even if you only loan the funds to the trust. Until the 5th of April 2025, the scope of inheritance tax was determined by the taxpayer's domicile status, and for most Australians living in the UK, a stay of less than 15 years meant that only UK assets were subject to IHT. However, that's changed from 6th of April 2025 with the implementation of the new rules. These determine the scope of IHT by reference to whether the taxpayer is a long-term UK resident, or LTUR. For non-LTURs, only UK assets are subject to IHT, whereas LTURs face IHT on their worldwide assets, and that can potentially include Australian family trusts. So what is an LTUR? The new rules have a general rule and then 2 exceptions and a transitional rule that can override the general rule in certain circumstances. So I'm going to take you through the basics of the rules and then walk you through a couple of examples to help explain it a bit better. The general rule is that anyone who is a UK resident for 10 of the 20 UK tax years preceding the current year is an LTUR. And once you meet that definition, it usually takes 10 full years of being non-UK resident for the scope of IHT to contract back to only cover your UK assets. This is known as the tail-off period. Exception 1 overrides the basic rule if, in the 19 years ending with the year preceding the current tax year, there was a 10-year consecutive period of being non-UK resident. So a good example would be 2 5-year stays in the UK, separated by 10 consecutive years back in Australia. Exception 2 can shorten that tail-off period from 10 years, depending on the number of years that the individual was UK resident before they ceased to be UK resident. And finally, we've got a transitional rule, but that was designed for taxpayers who left the UK before the new rules were implemented, so it won't apply to any of you here today. Sound complicated? It is. So let's go through a couple of case studies. Case study 1. Jane is an Australian national who arrived in the UK in March 2018. She'd never been resident in the UK before, and she plans to return home to Australia in 2027-28. Her assets comprise a UK property worth $380,000, 2 Australian investment properties with a combined value of $1.5 million, and an Australian investment portfolio worth $500,000. She's single and her daughter is her sole beneficiary. If Jane is not LTUR on her death, only her UK property is included in her estate and her IHT liability will be 0. If Jane is an LTUR on her death, though, all of her assets are included in her estate, and that gives her an IHT liability of £822,000. So option 1, Jane leaves before the 20th of April 2027. That means she's not resident for 2027-28, so she's only been resident in the UK in total for 9 of the previous 20 years. So she doesn't meet the general rule. Option 2, she leaves the UK in late November 2027, so she will be resident for 2027-28, which gives her a total of 10 years of UK residence, meaning that the general rule will be met. Under exception 2, since she'll only have been resident for 10 years in total, she will cease to be LTUR after 3 non-resident tax years, so from 6th of April 2031. So you can see that the timing of Jane's move in the 2027-28 tax year makes a big difference to her IHT exposure. If she can't leave early in the year, she might want to consider a short-term insurance policy to cover the tax risk until April 2031. Case study 2. So Tom arrived in the UK in 2014-15. Under the old rules, he'd planned to return home in 2027-28 before he became deemed domiciled in the UK. He'll leave the UK in early December 2027. His worldwide assets are valued at 3 million, including his UK home, which is worth 325,000. Tom's British wife and their 2 children will return to Australia with him. Under the new rules, Tom is an LTUR because he's been resident for more than 10 years at the time of his departure. He doesn't meet exception 1, so his worldwide assets will be subject to IHT, which creates a potential IHT liability of up to 1.07 million. But under exception 2, because he's only got a total of 14 years of UK residence before departure, he will cease to be LTUR after 4 years. So provided he is non-UK resident for 2028-29 onwards, he'll cease to be LTUR from the 6th of April 2032, at which point his inheritance tax exposure falls back down to 0. It's worth noting, though, that if Tom sets up a family trust to hold some of his wealth before the 6th of April 2032, the transfer of assets to the trust is a CLT and will cause an immediate lifetime charge to inheritance tax. In addition, the trust will be what's called a relevant property trust and required to register with HMRC and have ongoing obligations to inheritance tax for the whole life of the trust. So it would be much better for Tom to wait until after the 5th of April 2032 to set up the trust. And again, some short-term insurance might be worthwhile to cover any unexpected circumstances before 6th of April 2032. Before summing up, I wanted to briefly mention some of the other tax considerations. If you have UK ISA investments, these are not tax-free in Australia, so it's worth at least considering whether to close them before you move. If you own shares, for some shares, significant savings can be achieved by selling before you leave the UK, and if you wish, then reinvesting once you're in Australia. For others, waiting to sell until you're in Australia can achieve a tax saving. So the right choice will depend on the history of the particular shares. But given there are significant potential savings, it's well worth including this in your pre-departure planning. Holding cash accounts in any currency other than Australian dollars once you're Australian resident exposes you to the onerous and very time-consuming forex gain and loss rules. So it's well worth reviewing your position and minimising your UK bank accounts before you leave the UK. These are just a few of the key tax issues. There may be many more that apply to you. To sum up, I've covered a lot of very complex tax material in a very short space of time. Hopefully what I've given you is enough to be able to identify the particular tax issues that you'll face. Planning before you move is vital, and the longer the planning window, the better. Any advice needs to consider both UK and Australian tax as the systems interact. You don't want to reduce tax in the UK only to end up paying more tax in Australia. The advice needs to be specific to your particular circumstances, and I would strongly advise you to steer clear of the doing the same as your mate in the pub. I've seen it before and it rarely works well. In short, proper planning prevents unexpected and potentially nasty tax surprises. Thank you for listening, and now I'd like to hand you over to Geoff Taylor, who will cover the financial planning considerations of your move, particularly in relation to UK pension transfers. There we go, Geoff.
Good morning. This year I thought it would be a good idea for us to do a webinar so that Joanne could participate. Joanne's a co-author of our ebook, and there's a QR code at the end of this presentation. And if you would like a copy, all you have to do is fill in the QR code and we can send you a copy. And it's also a way to get in touch with either any of us, any of the speakers today, if you've got any questions. So I started in the expat space 20 years ago, originally in the Middle East and Asia. I've done 75 seminars or webinars in 16 countries, so I've been to a lot of places. But more recently, I've focused mainly on the UK. So this is our fourth going home event, and I think what we'll do in the future is we'll do a physical event in the even years, and we'll do a webinar in the odd years. So just a general advice warning here. So as an Australian financial planner, I have to tell you that this is general information. I haven't taken into account your personal circumstances, goals and objectives. If you did want me to do that, I can obviously do that and provide personal advice. So in terms of our key service offerings, it's worth mentioning that for our physical events, Dan Gorton is our expert UK tax advisor. He's based in London. So he's there for the physical events when we do them in London, and he's available for UK related pension advice. So Joanne's based in Australia like I am, and Majenda Australia is basically, we've got two businesses, one that does tax advice and one, Majenda Financial, does the financial planning advice. So the important thing is to remember that you can get advice before you leave the UK. And Joanne and I have collaborated on a lot of advice cases where people have obtained the advice anything up to a couple of years ahead of time, which I would recommend. Sometimes it can take 3 or 4 weeks for us to prepare that advice because it's complex, and so you can purchase that advice before you leave. Okay, so UK pension transfers is what I'm mainly focusing on today. I do have a Masters of International Tax, but I'm not to the standard of Joanne in the tax sphere, so I'm mostly focused on UK pensions. And I guess the key point to remember is that the UK pension transfer is a cross-border transaction. So to understand what's going on, you need to know something about UK pension rules, UK tax rules, Australian tax rules and Australian superannuation rules. And if you don't understand how all those interact, you can really come a cropper when it comes to doing pension transfers. And that's why it's worth getting advice. If you look at this slide here, you can see that the UK pension rules are totally different to Australia's superannuation rules. So we're on the other side of the world. I often think our system's upside down compared to the rest of the world. I see pension systems in other countries around Europe and the US and the UK, obviously very similar, but not in Australia. So we tax on almost like a TTE is the way I think of it. We tax on contributions, concessional contributions at either 15 or 30. We tax the money while it's in there at either 15% on income or 10 on capital gains. And then if you meet a whole series of criteria, you might end up with a tax-free pension out the other side. In contrast, the UK gives relief on the way in, exempt while it's in there, and mostly taxable on the way out, with the exception of the 25% PCLS. So really what we're talking about with UK pension transfers is a pathway out of the UK system and into the Australian system, meeting the rules of both the HMRC and the Australian Tax Office. And so the way to do that is to transfer the money to a recognised overseas pension scheme. So I'll actually go into what that is now. But before I do so, this is just a quick slide. Every time I update this slide, there's usually something that's changed. And so the thing to know about UK pension transfers is that they'll be treated as non-concessional contributions. So you're looking at the Australian superannuation rules, 120,000 per annum, which is 4 times the concessional cap. and you can use what's called the 3-year bring forward rule, probably dreamt up by a bureaucrat in Canberra, quite an unusual name. So there's no tax on those contributions except for the applicable fund earnings piece. And so you can actually put in 3 years of contributions in one go. So you can imagine that if you had a UK pension amount that was the equivalent of 360,000 Aussie or less, well, there's a pathway across. And then once it's into the superannuation system, as long as you keep meeting the HMRC rules for 5 years after the year of transfer, you can basically take money out under the superannuation rules. And that's when, if you start a pension, you've got the minimum drawdown rates, which start at 4% if you're under 65 and go all the way up to 14%. People ask me, why is that? Well, basically the concession that applies to super doesn't apply forever. Eventually investment earnings will not match the drawdown rate. But the reality is by the time you get to 85, you're probably not needing so much cash. So the money flows out of super. There's also a new rule, Division 296, because that's the section in the Act, that's what we call it. But it's really an extra tax on balances of above 3 million. It is not legislated. It is now subject to debate and may get changed. Okay, so we're talking CUROPS. And if you've heard that term, what it refers to is Qualifying Recognised Overseas Pension Scheme. And so in the background, the history started on the 6th of April 2006. And basically, this outlines the rules under UK rules as to how, what sort of scheme money can be transferred to outside of the UK. In our case in Australia, we've got two choices. One is what's known as the Australian Expat Super Fund, the Aussie Expat Super Fund, which is a retail fund. And the second choice is really to set up a self-managed super fund and apply to have it CUROPS compliant. And there's about 1,000 of those or more. And so they're your two choices. And really the choice that you will make will depend on your personal circumstances. We obviously do both. And so part of our service is looking at the tax and financial implications for each person and making a recommendation as to which is better for that person. So typically an SMSF might be better if there's other superannuation money that can be combined and you can get some economies of scale. Alternatively, you might use the AESF if you've got an industry fund solution for your normal super and you don't want to have the overhead of an SMSF. Okay, what pensions can be transferred? So you'll hear terms like DC and DB. So that's the lingo for defined contribution and defined benefit. There's more hurdles around getting a defined benefit scheme out. So you've got to have a study done to make sure that it is in your best interest to go one way or the other. So that's a UK advisor that would need to help you to do that. Typically a defined contribution scheme, if it qualifies, then it can be transferred to a CUROPS. The pension funds that can't be transferred, UK state pensions, certain types of annuities, company pensions, and unfunded public sector defined benefit schemes. So if you wanted to know whether your scheme is eligible or not, all you need is a copy of the statement and we'd be able to tell you whether it's possible to transfer your pension or not. So this is a new slide that I've developed because in my mind, I think of it as pension pathways, and I've just put up 5 different pension pathways. And really it's based on considerations about age, how much you've got to transfer, when you want to make that transfer, and whether it's tax effective for you to do that. So if you're under 55, the default do nothing option is just to leave it as it is. You could just say, I'm just going to leave it as it is. Many people would do that. And it would just continue to accumulate tax-free in the UK scheme. But obviously there would be some tax to pay potentially when you get to do the pension transfer. The second option is to seek advice from someone like Dan Gorton of SJP, and he will be able to advise you on a SIP or a suitable SIP or multiple SIPs. And that will mean you've then got an advisor who's helping you with choosing the investments and monitoring those investments and telling you at what juncture you can actually move them out of the UK. So the next pathway is if you're over 55, so this is the UK rule, and I've noted down the bottom that 55 requirement is actually going to 57 from the 6th of April 2028. So it is a moving feast in terms of rules. But if you're over 55 at the moment, then you can leave under the UK rules, but you've got to be under 75 to meet the Australian superannuation rules for non-concessional contributions. So you've got a 20-year window if you're now 55. And so because we're now applying the Australian rule around non-concessionals, the cap there is 360 at the moment. Now that could be indexed over time, so it might be a higher number in the future. So you've really got a window. If you're becoming tax resident tomorrow, you've got a 6-month window, and it would be possible, if you can get that transfer done within that time, that you would pay no tax on applicable fund earnings, which is effectively the growth between the date of tax residence and the date of transfer. So what counts for non-concessional purposes is the value as at the date of tax residence, and you've then got a 6-month window. Now, we had a case recently where we had wife through pathway 3, and unfortunately, despite our efforts, husband through pathway 4, just slightly outside the 6 months. And this is because UK pension providers, they've got strict compliance rules. They're very cautious of schemes. So, I mean, as an example, the other day we had a letter from a pension provider asking for evidence of your client's tax residency and, you know, which jurisdiction the CUROPS is. So tax residency and CUROPS being the same jurisdiction. So they were quizzing the client to make sure they were complying with the rules. And obviously the back and forth, in some cases we've seen pension providers send things by mail, and we've been required to respond on, you know, before the date is actually before we've received the mail. So often you can miss the 6 months. The 6 months sounds like a long time, but you really need the advice. You need to decide whether you need an ASF account or an SMSF. If you're going to set up an SMSF for scratch, that could take some time. If you're going to get it CUROPS compliant, that could be 4 to 8 weeks. So there's a lot of steps in this process, and that's why it's better to start off with advice before you set foot in Australia and trigger tax residence. So in the case of the husband, it wasn't too damaging. He missed by a few days. There was a bit of tax to pay. We'd done everything we possibly could, but he just missed out. So a bit of tax went off. And effectively what you do is you fill in a form and you say, now I've got a copy of the form here, choose the amount that your Australian super fund will pay tax on, and tax is paid. If it's in an SMSF, that gets paid as a part of the wash up at the end of the year. So if you've got more than the equivalent of $360,000, this introduces issues because it won't fit within the envelope of the 3-year bring forward rule. Also, if you've already used the bring forward rule in the past, you've got an existing bring forward rule that could cause problems. So there's potential to split the pension. There's potential to draw the 25%, the so-called PCLS. So it is more complex if you've got more than the equivalent of 360,000 Aussie dollars. This is where the UK advisor comes in, because he could advise you to split your pension into multiple lots. He could tell you to split and then do the PCLS. There's all sorts of strategies. And of course, the second tranche, if you're doing multiple tranches over multiple years, applicable fund earnings is going to come into play. But that may well still be better than the alternative of drawing a pension and having it taxed in Australia. So country of residence, the pension would be taxable under the treaty. And so our job is to work out which is the best tax outcome for you. So we do forecasts and so on. It is possible to bring historical pensions across. We've had cases where a client was taxed residence 30 years ago with £40,000, now £175,000. A lot of tax to pay, but it turned out with analysis that was the best option. It's important here with note 4 to be aware of the 5-year rule. So our first question is, are you going to be tax resident of Australia for the next 5 years? Are you going to go backwards and forwards between Australia and the UK or go to another country? So we're interested in that, and the advice will take account of that so that you don't end up with an overseas transfer charge, because these things can bite you and they can be very expensive. Listening to Joanne's presentation, you see the amount of planning that's really needed around IHT, CGT, income tax, pension transfers, the same deal. So why do people do UK pension transfers? Probably the most important is tax effectiveness. So our two businesses, our tax business will give the tax advice to see what's going to be tax effective for you. And some people will want the money in Aussie dollars rather than pound sterling. Some will want greater control. They want to combine it with their other superannuation money. Some will want to start a transition to retirement pension straight away. They may be able to get access to the money straight away by doing a pension transfer and starting a TTR on Australian rules. And that might be a strategy. We had one of those strategies not so long ago, and the client has continued to max out their concessional contributions while earning income, but they've got access to money via a TTR. Also, estate and succession planning issues are there as considerations. So the bottom line is you've got two systems and two different sets of rules. You've got cross-border transactions, and generally speaking, you know, you want to speak to us. We think of ourselves as the Return to Australia Dream Team. That's Joanne, myself, and Dan. And between the three of us, I'm sure we'll be able to address any issues that you might have. So we've just released the 4th edition of our ebook, which was very well received during our physical events in the UK. And I'll just put the QR code. This is, if you can click on that QR code if you'd like to receive a copy. We won't be able to send it to you today because it's quite late here in Sydney tonight, but we will send you a copy tomorrow. And if you'd like to ask any questions, if they're questions for Joanne or Dan, I'll be able to pass them on. I actually am headed to Switzerland via Dubai on Thursday, but I'll still be in email contact. So that's all for me. So thanks for your participation, and I look forward to catching up with you in the not too distant future.
Thanks, Geoff, and thank you, Joanne. A fair amount to consume there, but the ringing message through both presentations so far, and I know it's a theme of the third presentation, plan well before you move. On that note of moving, I'd like to introduce Paul Davies, who runs Careline Moving Storage UK, and Paul will cover some of the practical elements of actually physically getting from A to B. Paul, the screen is yours.
Thank you, guys. So I'll just pull it up now. Bear with me. Right. So as Richard pointed out, look, good morning, everyone. My name's Paul, and obviously I'm the UK General Manager for Careline Moving and Storage. So Careline is an international moving relocation company specialising in moving individuals, families, companies and employees from the UK and Ireland to Australia and globally. Today I'm going to talk to you about the moving services to Australia, and hopefully today will give you a bit of a better understanding on the different types of services, the documentation processes, along with what you can do when it comes to planning, budgeting and the potential impacts. I'll also touch base on the requirements for insurance, moving pets or cars, and the restrictions, and basically, and how we can help you with that move. So starting off with the different service types. So by far the most common types of moving services to Australia is sea freight services. These are split into different types, such as which are called full container loads or FCLs. There's also groupage and baggage service options. So full container loads offer the quickest transit time by sea, as this is a dedicated container service option. Full container loads are split into 3 different types. So this is a 20-foot container, 40-foot and a 40-foot high cube container. So a 20-foot container, so this holds approximately 30 cubic meters. So what is this, you ask? Well, it's probably the equivalent of a 2-bedroom flat home or a smaller 3-bedroom house. A 40-foot container, which is double a 20-foot container and holds approximately 60 cubic meters. And this is the equivalent of a 3/4-bedroom home. A 40-foot high cube, which is a slightly bigger 40-foot container, which holds 70 cubic meters and is the equivalent of a 4 or 5-bedroom sized home. Other services are groupage services. So this is still sea freight, guys, and is a shared container service option. So it has a slightly longer transit time as it waits to consolidate. But the main advantage here being it's the most cost-effective sea freight option. It's generally for volumes that don't necessarily fill a full container and can be anything from a few boxes to kind of half a container worth of goods. Other services, so baggage services, as the name says, basically this is just when you're looking to ship home kind of a few bags, a few extra suitcases, whatever that might be. So this is again a sea freight service option with the same transit times as groupage services. Again, this is really cost effective and works well when it's just a few extra suitcases or bags you're looking to send home. And last of the kind of services is air freight services. So this is really the most expensive method of shipping goods home. So this offers a much shorter transit time, approximately 2 weeks, but is very costly. So generally suited for items that you require immediately whilst waiting a sea shipment to arrive, such as clothing, bedding, baby items, whatever that might be. Okay. Next, I'm going to touch base is on insurance options. So we do offer full insurance protection for all moves to Australia. This is not compulsory, but obviously highly advisable given so much of the journey is in the hands of third parties, such as shipping lines or airlines and so on. So the most common type of protection that we sell is what we call our marine goods in transit policy. This is a full comprehensive coverage option. So the summary points for this are the coverage will cost you 3.5% of the total declared value that you declare to us. All values should be based on replacement costs at destination. Any singular items that are valued at £2,000 or more are deemed what we call high value items, and they may require additional protection such as wooden crating to protect those, which obviously does come at an additional cost. Coverage for storage at origin or destination of up to 60 days is also included in the policy. Also to mention that you do have between 7 and 14 days post-delivery to also check your items once they arrive to you in Australia into your home. We also require a valued inventory of all your goods you're looking to ship so that valuation can be determined. And there is an excess of £150 in the event of any particular claim. So like all insurance policies, there are restrictions and exclusions. I've highlighted some of these on the right hand side for you. I won't go through these in too much details, but the main ones are listed here. So if you do have any questions on this, please do feel free to reach out. Next, I'm going to talk about planning and considerations. So like anything, planning early is highly recommended. We recommend approximately 6 months out from your move date is a good place to start. Having conversations early in the process can to gain a better understanding of what types of services you require, the volume of items you're looking to send home. So look, don't be afraid to ask for multiple quotations based on different volumes and service types for cost comparison. So we do offer what we call a free non-obligation home survey, which is either in person or via WhatsApp, where you can highlight what you're looking to send, discuss options with us, and based on that, we'll offer you those multiple quotations on the different service types, so you can compare and choose what fits your needs best. Prioritize and clear out. So look, this is important. I recommend it. It's one of the most common feedback points that I receive from people who have moved back home, you know, saying, I wish I hadn't shipped so much stuff. Look, due to the length of time that the shipment takes to arrive home, which I'll discuss in a little bit, look, things can change. And by the time it often reaches Australia, you find you don't quite need everything that you intended to ship originally. So look, keep it to a minimum and save money in the process. Remember, there's IKEA in Australia too. I put this in there because everybody has IKEA now and spends thousands to ship the stuff back home. So look, the reason I say this is if this is the difference between, let's say, a 20-foot container and a 40-foot container, which costs an extra few £1,000s, then cutting back on your IKEA items is a good place to start to save costs and repurchase those back in Australia. Pets and cars. So we'll touch on these in a little bit, but these do require additional procedures, time and expense. which add also to the planning timelines, and these can also increase costs and add delays to your shipment. Potential additional costs, I will touch on some of these in the next section, but just be aware of these up front. Have an idea of what these might look like for you based on the service types that you're looking to take for your move back home. So next, I'm going to talk about the impacts. So starting with kind of shipping rates, shipping rates. Generally, shipping rates are only valid for 30 days. They can fluctuate depending on global events such as wars, availability, and seasonal peaks. So your initial quotation, let's say 6 months out in your planning stage, can potentially change by the time your moving date comes close. Shipping availability, like rates, can change depending on global events such as wars, peak season, or increase in trade or on certain routes. And volume impacts every quote, guys. The more you send, obviously, the more expensive it becomes. Transit times are often very fluid. I've highlighted here in the budgeting section, which you'll see further down, what these look like as they stand today. But these can change based on global events and availability also. Port congestion once your container arrives in Australia, this happens quite frequently, where the allotted clearance time of free time that we're granted to clear your container into Australia, and the Australian ports will be hit with heavy congestion, which is unforeseen at the time of initially shipping. This will add additional costs to you guys, which will only be known once it arrives and we know how long the port congestion has taken to clear the container off the port. Biosecurity, we'll touch on this in a little bit, but all shipments going into Australia are biosecurity inspected. This can also add potential delays, and also due to the availability of inspection officers, which are and all the inspections are mandatory, can also add additional cost too, right? So below in the last table, you'll see how I've put together some very basic budgeting with transit times based on FCLs or full container loads, and a typical groupage shipment of 10 cubic meters. So 10 cubic meters is probably the equivalent of a 1-bedroom flat worth of furniture and contents. So obviously in the left-hand side of the column is the service type, middle column being the budget, and the right-hand column being the estimated transit time. So FCLs generally are 12 to 14 weeks transit time. Groupage shipments 16 to 18 weeks as it currently stands, and obviously air freights, as we spoke about earlier, around about 2 weeks. So next, I'm going to talk to you very briefly about the documentation that you'll require going into Australia. So look, I'll touch base on some of the key points. So you must be a returning Australian citizen or have a visa, permanent or special category. And a completed Australian Customs declaration of B534. This is the statement declaration for unaccompanied personal effects, or UPEs, via the UPE pathway. We do the application on your behalf. You will be required to submit a copy of your passport and visa if required, along with an insurance valued inventory. We create the shipping inventory, which when we collect your goods, which is required for shipping importation purposes. Also, if you're sending motor vehicles, pets, an import permit approval is required, and I'll touch on this in a little bit. So unaccompanied personal effects, or UPE shipments, can be imported GST and duty free, so long as the goods are intended for personal use only and are owned for 12 months prior to shipping, with the exception of items like clothing, footwear, toiletries, grooming products, etc., which don't have to be owned for 12 months prior to shipping. So items that will attract GST and duty on importation to Australia. So items such as motor vehicles, alcohol, commercial items, and newly purchased furniture items are just some of the items listed that must be declared and will attract GST and customs duty on importation to Australia. Next, I'm going to talk to you briefly about biosecurity. So as I mentioned, all unaccompanied personal effects are subject to biosecurity inspection by the Department of Agriculture, Fisheries and Forestries for items of concern that may bring pest or disease into Australia. So DAF, which should we call it, they do document checks on your B534 and also the shipping inventory just prior to arrival into Australia. And then basically we'll carry out inspections. So the costs of inspection fees vary based on volumes or container sizes. A 20-foot roughly is around about Australian dollars $700 to $900. a 40-foot about 1,100 to 1,300 Australian dollars, and a groupage has a minimum charge of $350 or $45 per cubic meter, whichever is higher. So I've listed on here kind of the main items of concern by DAF, but it's generally anything that has come into contact with soil, plants, water, food sources, or whether like our outdoor items are of interest and will be inspected. Also, items that are originating from plant or animal material will be inspected, and these are advised against shipping. All items that have come in contact with soil, plants, water source, food, or weather must be thoroughly cleaned prior to shipping. If DAF do require further cleaning, fumigation, or destruction, additional charges will apply, and these can be quite significant and will cause delays to your shipment coming into Australia. So next, I'm going to touch on motor vehicles shipping to Australia if you're looking to send a car. So firstly, it's encouraged to obviously check your eligibility if your vehicle can be imported into Australia with the Department of Infrastructure and Transport. This is done via the Rover system, where you can put the details of your vehicle in there and it will tell you if it's eligible. You must have owned the vehicle for 12 months prior to shipping, and it can be imported via the unaccompanied personal effects pathway. There are a few different pathways, sub-pathways in the unaccompanied personal effects pathways program, which will depend on the vehicle type, age, value, and its fuel efficiency. A vehicle import approval is required and takes around about 2 to 4 weeks to get the approval. It costs around $50, and you can also apply for that through the Rover system. So all vehicles entering Australia must meet Australian design regulations. Modifications may be required to meet the standard. This needs to be done by the manufacturer or a registered automotive workshop. The cost for these can be considerable depending on the modifications needed to meet the regulations. Vehicles which are 25 years and older have a different pathway, can be slightly easier to import also. Electric vehicles are probably the most costly to ship. This is more down due to the shipping lines having restrictions on lithium-ion batteries. Some shipping lines refuse them altogether. Some do accept them, but then they are classified as dangerous goods, and therefore a dangerous goods surcharge is applicable, which adds to additional costs and also times. All vehicles must be professionally cleaned for biosecurity prior to shipping and will undergo mandatory inspection on arrival into Australia. Further charges for this inspection also do apply. So vehicles can be loaded in shipping containers with your personal effects to save on cost and also maximize container space. All vehicles must be drained of fuel and batteries and batteries disconnected where possible. So GST and customs duty apply on all vehicles coming to Australia. GST currently 10%, customs duty 5%. Also worth to be noted is there is a luxury car tax which is applicable, and this is set at 33%. There is a formula to this, and I can share that with anyone should they wish to know more on that side. The threshold for the luxury car tax is set at Australian $80,567 for other vehicles and $91,387 for what they call fuel efficient vehicles or FEVs. So in the bottom table below, I've kind of put together for you what you would be looking, let's say, to pay on GST and customs duty on a vehicle of a value of around about $60,000 coming to Australia. There are calculators and things online which you can jump on and just and have a look at any time. So next we're going to talk about pets if you're looking to take your pets home. So firstly, again, like vehicles, is checking the eligibility because your pet must meet the Department of Agriculture, Fisheries and Forestry's requirements. Prepare well in advance for moving your pets. Recommendation is around about 8 to 10 months out from when you're looking to move. So animals from the UK are deemed category 3. So these are the least likely to be carrying rabies and disease. Animals are required to be microchipped, have rabies vaccinations and various blood tests at different stages prior to shipping. Once this is done, then they will be issued with what they call an export health certificate. Again, an import permit approval is required taking your pets home, which can only be applied for once the export health certificate is in place. So the import permit will take around about 20 to 40 days for approval. All animals entering Australia must quarantine. This is for a minimum of 30 days. It can be reduced to 10 days, more often likely does with animals coming from the UK, as long as they've met all the requirements. There is only one quarantine centre in Australia, which is situated in Victoria. Once your animal has completed quarantine, it is then transported to your home city airport for your collection by yourself. Costs, and this do vary depending on breed, size, age, health, and the length of quarantine requirements. I do recommend using a specialist company, not undertaking this yourself, because it is quite a lengthy process. You will be glad to know you can actually visit your pets in quarantine if you wish to do so. And often what you'll find is your move dates will be dictated by your pet. What I mean by that is obviously the length of process, and quarantine in Australia does get heavily booked right now, and does have a waiting list. So, planning early is vital. And obviously your final move dates will only kind of be dictated for when your pet can start its travel and journey into Australia. Lastly, all animals going to Australia do require a pet-friendly crate for transport. This can also add significant cost. They are costly. And my tip here is basically try and sell the crate once you're finished. Sometimes even the specialist companies will buy these back from you, so you can actually get a little bit of a rebate. So next I'm going to talk about the kind of prohibited or restricted items going into Australia. So look, Australia does have quite a sizable restricted prohibited items list on imports. Look, your everyday, your everyday household items are fine for importation. I have added a list here of kind of the ones that are restricted or prohibited for shipping into Australia. But and also, if you are looking to send any of these items, they will add additional costs and delays. I won't go through these one by one, but I've also dropped a link in there for you so that you can also check these if they're not on the list, or you do have items of concern which you do want to check. So next, I'm going to talk about us and how we can help. So Careline, as I've mentioned, is a specialist door-to-door international moving company, which covers both the UK and Ireland. We have operational centres in London, Dublin, Cork, Limerick and Belfast. Australia is a major traffic lane for us, and we do complete over 1,000 moves, international moves per year. We also can arrange any moves from Australia back to the UK and Ireland also. We offer storage in all of our operational centres, both in the UK and Ireland, and in any major Australian city through our partner network. We have an outstanding claims ratio of a claims rating and 95% on-time delivery success rate. We are also part of the British Association of Removers and International Association of Movers, for which we have trusted status accreditations. So this obviously gives you guys, as the consumer, protection of both A, quality services, and payment protection of those services as well. In addition to that, we are also ISO 9000 quality management system certified, and also 14001 environmental management systems accredited. So look, please feel free to reach out to myself for your free non-obligation home survey, or even just to discuss your moving home needs. We're always here to help. That's what we're here for. And lastly, I just want to thank everyone for their time today. I hope I've managed to give you a bit more of an insight into the logistics side of moving home. But again, if you do have any questions or anything at all, please just feel free to reach out. We will happily answer anything you might have. Also, as part of our offering today, we are offering Australia UK Chamber members 10% off your move home. Just quote that code CARE 2025. So again, thanks everyone for your time today, and get in touch when you are looking to move.
Thanks, Paul. That was really comprehensive and very helpful. Again, just to our people online, we will be providing a follow-up email later on this afternoon with contact details for each of our speakers with their email addresses. We'll also provide a link to the e-document that Geoff mentioned earlier, but everything will be captured so you won't miss out. We're going to have a Q&A right now. We did have a finish time of 10:15, but if it's all right with everyone, if you can stay on, we're going to go over through to about 10:30. We're not going to shut it down just for the sake of the time restriction to 10:15. So what we'll do is, if we can, we might start with some questions that were submitted in advance of the webinar, and they were pretty much directed to Joanne and Geoff. So we might start with those, and we've had a handful of questions coming through on the Q&A. And for those people, if your questions aren't answered in this session, even though you've submitted them online today, we'll make sure they get back to either Joanne or Geoff or Paul, and they will follow up with a response. So your questions will be answered. All right, Joanne, do you want to lead the charge on this and maybe pick a question, or Geoff, a question that sort of came through in advance that you may want to tackle?
So I think the one that seemed to come through quite often was people asking about whether they would still get main residence exemption if they kept their UK homes after moving back from Australia, which I touched on a little bit in the presentation. So you can only have one main residence. So if you leave the UK and you move back and you've now got a nice home in Australia that you're probably going to want to treat as your main residence, if that's where you're living, that's going to mean that the UK ceases to qualify. And exactly what that means in terms of how much the taxable gain will be when you sell it will depend on how long you hold it while it's not your main residence.
I have a number of questions in the Q&A. Can I just shoot a couple of these if I can? And by the way, the Q&A, for those people that are concerned that their name may be called out, we're not going to actually upload the Q&A session for protection of those individuals. For IHT, if you have been in the UK more than 20 years, does the relief still apply for 10 years outside the UK, or is it more?
No, it's still 10 years. So if you've been for 20 years, you will be an LTUR, which means you're then going to need 10 consecutive years of non-residence in the UK, and then you'll cease to be an LTUR. So you're always going to have that 10-year planning window. But no, if your stay is longer than 10 years, it doesn't get any longer. It's always a maximum of 10.
Let me go to a couple of the other questions here. What happens to ISAs when you leave the UK? What should we do with the ISAs? What other key watch outs are there for stocks, funds and cash savings accounts?
Okay, so ISAs you cannot contribute further to once you're non-UK resident. So you can leave the balances there if you like, and they will stay tax efficient for UK purposes. So the UK won't tax the income that's grown on them and won't tax any gains. But you can't put any more money in. So they just sit there. From an Australian perspective, as soon as you're an Australian resident, the income that's earned on those ISAs is taxable income. So, and the challenge that we have with ISAs is because UK providers are expecting it to be not taxable, getting the reports that we need to prepare your Australian tax return can be really quite challenging. So your options are to either leave them in the UK and accept the fact that they're going to be taxable in Australia. And they're not necessarily worse than any other kind of investment. It's just you've been building them up on the basis they were tax efficient and they're no longer tax efficient. Or you could sell them while you're in the UK, take the money out and reinvest it once you get to Australia. Selling them in the UK is going to have no tax consequences as long as you're resident in the UK while you do it. And then you can look at talking to a financial advisor like Geoff when you arrive in Australia to look at better places to invest once you're back in Australia.
Geoff, I think this one's for you. Can you transfer to a QROPS while still UK resident, non-AU resident? And you're on mute, Geoff, just to give you the heads up.
Yes, I just wanted to extend on to Joanne's point there, that as a general proposition, you want to tax optimise for the country in which you are resident now or where you are going. So where you where you're going cross-border, and this is where the ISA issue comes up, is that you won't have the tax benefit in Australia that you've enjoyed in the UK. And it applies irrespective of many jurisdictions, that you want to work out how to tax optimize for where you are going, and that's what it's all about. And so then talking to an Australian financial planner, they're actually going to focus on how to optimize you for superannuation rules, tax rules, and so on. And this is the key thing. But it may well be better to exit the ISA, before you leave. Same with the pensions. You're looking at what is your best option going forward for where you're going to be.
All right, and just going back to that question, Geoff, can you transfer to QROPS while still UK resident, non-AU resident?
I think theoretically you can, but the question is, why would you if you're enjoying tax concessions while you're in the UK? So typically the trigger is, I'm getting ready and I've triggered tax residence. You've got that 6-month window. Typically that's what you would do. So there might be more challenges around getting the advice and getting everything lined up. But I think technically you can.
I'd just add to that if you are transferring to a QROPS in a country that you're not currently resident of, there is a pension transfer charge that would apply in that circumstance. So as Geoff says, you wouldn't want to do it. But
you could set it up, you could start the process. So you could start the process so that everything was ready for when you arrived. So you're getting a head start on that 6 months. So obviously, you've got the tax residence by the time you move that money.
All right, I might go to just the last question, and then we might wrap this up. Are there tax impacts of receiving a UK inheritance once we've moved to Australia, assuming it will already be subject to UK IHT?
Oh, that's a big question that has many possible answers. So the tax that it faces from the person that you're inheriting from is based on their scenario, not your scenario. Generally, gifts of inheritance are tax-free as long as you can prove that's what they are. Obviously, once you invest it, then any income you earn on it is taxable. But then the other thing you've got to think about is if perhaps this inheritance includes some UK assets and you as an Australian resident are inheriting them, that's going to have some UK tax implications for you. And it can also, although Australia has no inheritance tax, it does have capital gains tax on death. And when you have UK assets, that's a classic example when Australian CGT on death can apply. So I guess there's two sides of that story. The status of the person in the UK that's giving it to you doesn't really have any effect, but you need to think about the implications for you as the receiver.
Okay, one last quick question, Sam. We didn't want to, from a particular person, for Paul, from Sam, no surname. Question for Paul, does Careline do removal with smaller book boxes and tea boxes? Do you have a rough cost estimate how much to ship 5 or 10 small boxes would cost?
Yeah, so look, shipping freight services, sea freight services for around about kind of 10 boxes, you're looking at around about the kind of £500 to £600 mark on door to door. Obviously it's based on volume, so depending on those book sizes, those boxes, whatever you might need, about £500 to £600 currently as it stands now. It does change, right? So it's quotes are valid for 30 days. Okay,
there is a question here because I have an interest in this question. So I'm going with another question. Joanne, get ready. In the 10-year IHT tail, does it reduce each year? E.g., after 1 year, you have 90% exposure, 2 years, you have 80% exposure, etc.
Sadly not. No, it's just a case of until you get through that 10-year tail-off period, your worldwide assets are subject to inheritance tax. So if an IHT event happens in that time, you're clobbered. Unfortunately.
All right. I'm going to try and end on a positive note. Okay, Paul, back to you. For moving households, is there help advice for customs and immigration issues? Does Careline inspect or sense check riskier items before packing to avoid issues at the other end?
Yes, we do. So basically, our packers are all trained on what is prohibited and what isn't. We send you that information prior to the packing commencing as well. I will also, or whoever will do your home consultation will discuss this with you too. But yes, ultimately, our guys will, or our operatives will also make sure that we don't pack anything that shouldn't be packed, and we will question it with you. All right.
Okay, I'm going to stretch the friendship. We're going one more question, and I will still wrap it up. For children's ISAs, where we can't withdraw funds, would these be subject to forex gains losses every year? Do we need to submit tax returns for children, or can they be done as part of the parents' returns?
So yes, the ISAs will be taxable. Whether they're taxable on the children or you depends on the scale of them, because there are rules in the UK, in Australia, about the amount of income that a minor can earn. So it would depend on the quantum as to who has to pay tax on them. But yes, unfortunately, because you can't move them, it's just a case of you're going to need to deal with that taxable income.
All right, fantastic. Look, I will wrap it up. Thank you for everyone who's stayed with us throughout this webinar. As I said, we will provide a follow-up thank you with contact details. And I know Paul, Joanne and Geoff will be happy to reach out and follow up on any questions or queries. Just a couple of comments. The note we send out this afternoon will also have a link to the webinar itself, so you can review some of the content. We've covered enormous ground today. We really have. It's been fantastic. That message that came through on all three presentations is plan well before you go. It's such an important, simple message, but it's an important one. In terms of last promo from the Chamber, just a couple of events that will be coming up in the future that I think may be relevant to people who are on this webinar already. We've got an event on October the 2nd called Geoshocks and Global Commodity Markets. We've got a couple of people from ANZ, experts, who will talk about what's going on in the commodities markets. And for those of you who have some investments in this particular area, I think it'll be a highly informative panel discussion. So October the 2nd, details are on our website. And also post the autumn budget. The autumn budget's coming up on November 26th. We'll do a review of that the next day. Am I expecting some unpleasant surprises for our non-dom regime? I am. No comment will be passed, but I am. So I would encourage a lot of you people to look out for that particular webinar. Again, that will be helpful and informative. Again, thank you everyone. To Joanne, Paul and Geoff, my genuine thanks. That was incredibly informative, covered a lot of ground, and it's all will be in the follow-up. Thank you everyone, and have a great rest of day.
Thank you all.
Thank you.